Hey everyone, Ben here. It's no surprise that this past year has been the year of the growth stock, from Tesla, which skyrocketed by around 400%, to smaller companies such as Blink Charging, which went up by 4,000%. So why didn't everybody just invest into these growth stocks? Well, although they were covered on this channel, this comes down to the major argument between value and growth, and how much should you really be paying for growth stocks. So to help you guys out, I've actually created a brand new metric, a financial metric, and a method of actually valuing growth stocks. This should be really interesting. And then I'm going to take you guys into my time machine. We're going to go back to 2018, 2019, and see if this metric could have helped us to identify some valuable growth stocks. If you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you do find any value at all in these videos, feel free to give this video a big thumbs up. That helps out tremendously with the YouTube AI. If you do want to know exactly which stocks I'm buying, which stocks I'm selling, in addition to accessing my entire investment portfolio and being able to talk to me directly about your own investing and investing decisions, then check out that first link in the description below for the VIP membership group. With that being said, let's dive in. So what's the problem? Well, classic investors such as the great Warren Buffett use a very strict style of value investing, which often means they can miss out on some great opportunities. For example, Warren Buffett himself in many past interviews even admits missing out on valuable growth stocks such as Amazon and even Google. Buffett actually had the founders of Google, Larry Page and Sergey Brin, in his office pitching to him to invest into Google, and Buffett just turned it down, partly because it's a technology company which Buffett didn't invest in, and also due to the valuation.
Google and Amazon, those two in particular, let's take those two.
That's a pretty damn good question, but I don't have a good answer. I definitely should have owned Google. The guys came to see me before when they were...
Larry and Sergey?
Yeah, and we were, this is a long time ago. I mean, this was before they went public, but they were talking to me about a little bit about it. And we were using search at Geico in a significant way, so I knew the power of search.
What do? Do you kick yourself? What does Warren Buffett do?
No, I don't, because I made so many mistakes. You know, if I tried to kick myself, my legs would be exhausted. I mean,
So I personally love many things about Warren Buffett's own investing style, but even he recognized that this could be a potential flaw, and that was until he met Charlie Munger, his good friend and business partner. So Charlie Munger introduced Warren Buffett to paying a little bit more for exceptional companies. And this is where the famous quote comes in: it's better to buy a great company at a fair price than a fair company at a great price. In other words, paying a little bit more for a great company is a great way to invest. Now, I personally consider myself an amalgamation between a value and growth investor. Thus, I try and merge two different philosophies together in order to achieve the greatest investment returns. Now, there's a major problem with valuing growth stocks today, and this is why many pure play value investors just tend to ignore growth companies. And these are their words, not mine. Now, the issue with this is many growth companies have negative free cash flow, they're unprofitable, thus many traditional metrics used to value companies just don't work. You can't use free cash flow calculations on a company without free cash flow. You can't use a price to earnings ratio which takes the share price of the company, divides it by the company's earnings if the company doesn't have any earnings, if it's unprofitable company. So if you guys watch this channel regularly, you'll know I get around all this by using a metric called the price to sales ratio, which is very useful and one of my favorites for valuing growth stocks. So this takes the share price of the company and divides it by the company's sales. For example, one company could have a price to sales ratio of 4, so you're paying 4 times the company's sales. Another company could have a price to sales ratio of 50, so you're paying 50 times the company's sales. This all depends on market sentiment and the optimism behind this company. But also another factor that this metric doesn't take into account is growth, and that's the growth rate of the company. Because if a company is predicted to be growing a lot faster and this seems reliable, then shouldn't we be incorporating that into our metric? Now, the legendary investor Peter Lynch, who was the fund manager for the Magellan Fund at Fidelity Investments and beat the market multiple years running, he actually recognized this as an issue with the price to earnings ratio, and he developed a new ratio called the price to earnings growth ratio, or the PEG ratio. So this is great. You basically take the price to earnings ratio and you divide it by the company's growth rate. Now, this is a great metric for valuing profitable growth companies and can work for many of them. However, it's still not a very good metric for valuing unprofitable growth companies, which there seem to be a lot of these days. For example, great companies like Tesla were only profitable this past year, and there were so many more. So what's the solution? Well, I personally have done a heap load of research into this, and I've actually come up with a brand new metric which incorporates both the price to sales ratio and the growth rate for the company to help us value growth stocks. Overall, the goal of this is to help us identify growth at a reasonable price, or GARP. So what's this metric? Well, drum roll please. So this metric is called PSG. No, not that PSG. This PSG stands for price to sales growth ratio. Copyright motivation to invest. This is similar to the PEG ratio, except instead of the price to earnings ratio, we use the price to sales ratio. So we divide the price to sales ratio by the company's growth rate. Okay, so let's dive into this spreadsheet I've created with the new ratio, and I'm going to take you guys back in time. And we're going to see if we could have potentially identified a few incredible growth stocks using this ratio. Now, this spreadsheet is available for download in the VIP group. I will be linking it in there for you guys to download and actually play around with the different numbers in there. So let's dive straight into this. Back to the future, of course. This is exactly what we're doing right now. Back to 2019. So what I've done here, I've got the revenue from 2019 for these companies here. So we've got Tesla, we've got Etsy, we've got Wayfair, Shopify, Neo. Now, many of these I did actually invest into. So I invested into Tesla, Etsy, Wayfair. I didn't invest into Shopify or Neo, but let's see if we can identify the great growth companies with this ratio. So I've put the 2019 revenues here, growth rate there for the company. I'm using the projected growth rate from that time approximately. So we've said 50% there, 70% for Etsy, which is quite on the high side. Wayfair 55%, Shopify 60%, Neo 100%. I've got the share price, I've got the shares outstanding, I've got the sales per share and the price to sales ratios from 2019. So firstly, just diving into the price to sales ratio, we can see back then in late 2019, Tesla was only trading at a price to sales ratio of approximately 3.7. Now that's really, really low compared to what it is now, and I'll go into the prices now a little bit later. But let's dive into this metric which I've created, the PSG price to sales growth metric. Now, this is more strict, I consider it, than the PEG ratio, because the PEG ratio looks at earnings, it looks at the profits of the company, which really is the lifeblood of a company and why a company is created, to actually create profit. Thus, according to Peter Lynch, a good PEG ratio is a company which has a PEG ratio less than 1. In this case, as ours is a sales ratio, price to sales growth ratio, I'm going to consider a good price to sales growth ratio is a company which has less than 0.5. So all will make sense in a little bit. So firstly, let's dive into Tesla, and we can see straight away Tesla has a price to sales growth ratio in late 2019 of 0.07. And from this calculation, that means it was a buy. We can also see the same for Etsy, 0.1. We can also massively see the same for Wayfair. That was definitely a buy, and that was actually the best performing, I believe, out of all these stocks on this list. Shopify 0.44, so yeah, just made it Shopify, not massively under the 0.5 threshold. Neo also made the list as a buy. All the others would have made a buy in 2019 and brought you guys some fantastic gains. So what I'm going to do now is flash forward to 2020. We're going to apply the same ratios again to the new valuations of these companies. So here we are in 2020. That was a crazy year. We got through the whole pandemic, lockdown, etc. And now we have these crazy valuations for these companies. So in this case, we've got Tesla's market cap now as 800 billion. So crazy to see. Growth rate projected at 40%. Price to sales 26 now. Etsy, we can see here, price sales of 21. Wayfair, price sales of 2.2. Shopify 66. Neo, price to sales of 50. Unity, and I've added a couple more on there. I'll go through them. So let's just dive straight into the price to sales growth ratio, PSG. Now, the ones in red and the ones in orange, basically the ones in red, these are ones that are way over the threshold and wouldn't be a buy right now in terms of their growth. And so if we look at those here, we can see, firstly, we've got Shopify. This is a 1.4 on the price to sales growth ratio. And basically what this means is the company's growth is not worth paying for at this stage. This is just obviously a rule of thumb. It should be used in conjunction with various other metrics and, of course, your own intuition. Of course, look at the management of the company, the business model of the company. This is just one metric which shouldn't be used independently. Shopify's projected growth rate is 47%, which is incredibly good, but their price to sales is 66. So you're paying 66 times the company's sales to purchase Shopify stock, and the growth rate is 47%. Now, the way this would make sense is basically if the growth rate is higher than the price to sales ratio by a massive amount, then it can become good value according to the price to sales growth ratio, the PSG. Copyright, motivation to invest. No, it's not copyright really. Use it if you want. The ones in orange, they're slightly over. So Tesla, although it's projected to grow at a 40% rate, these projections are all from analyst projections on Yahoo Finance. So although Tesla's projected to grow at a 40% rate on the revenues, I'm not talking about stock prices here, on the revenues of the real business, price of sales of the company is 26, then basically this is a 0.65, which isn't too bad. But generally, as I've stated here in my rule, I'm looking for less than 0.5 to make it a buy or actually a good purchase right now. Etsy is slightly over 0.56, as this company has a growth rate projected of 37 and a price to sales of 21. These are two of my major holdings at the moment, Tesla and Etsy. And I know both of these stocks have run up massively because they're two of my biggest gainers in my portfolio. Now, NIO is a 0.8, so not as bad as some people might think. So the growth rate projected for NIO is 60%. It's still quite a small company, market cap 95 billion, but the price of sales is 50, so you're paying 50 times the company's sales. The stock that actually, according to this, is great value now is actually Wayfair, because this is projected to grow at 30%, but only has a price of sales of 2, so you're paying 2 times the company's sales, and thus that's why we see such a low PSG ratio. So it's clear this price to sales growth ratio does work and is a great way to actually analyze and quickly see if a stock has good value and if their growth is worth paying for. Now, eHang is a very interesting one. This is the air mobility company, very popular recently as they're a market leader in their technology. Now, the market cap for this company is 3.97 billion, so still quite a small company. The growth rate is projected to be 100% growth rate, and it did this last year, so it's not really unbelievable for this company to have 100% growth rate. But the price of sales is ridiculously high, so 144 times the company's sales. So according to this, again, the stock is overvalued. No surprise to many people. So what would make this stock fair value? Well, if we play around with this price to sales ratio, this would allow us to analyze what would happen in a market crash. So if we drop that to 70, we can see, it's still a little bit overvalued. Let's drop it to 50. So at 50, a price to sales of 50 on eHang. So if eHang dropped to 50, and 50 is still a high price to sales ratio, but it kept this growth rate of 100% and the fundamentals of the company hadn't changed, then according to this PSG ratio, the company would actually be a buy at these levels. So to me, this is a fantastic indicator and a great way to quickly look at stocks and see if a growth stock is a good buy or a good sell according to the company's growth rate. So if you guys want to check out this spreadsheet and play around with some different numbers and companies, I'll leave a link for this spreadsheet in the VIP membership group for all you guys to access. In the VIP group, you can also get access to my live buys and sell signals in addition to my entire investment portfolio. Also, if you guys are new around here and you still haven't subscribed to the channel, feel free to join the investing community by hitting that subscribe button and turning that notification bell on. If you did find any value in this research, in this video, then feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. This is a non-hype video, but I think it's actually got some real gold in it. So let's see how many views and likes comments and likes these type of videos get, and that will predict what type of content comes out on this channel in the future, because really this is the real value which you guys need to learn rather than the hype, but the hype seems to get a lot more interest. So let's see what happens. I'd love to hear your thoughts in the comments below if you want more videos like this. With that being said, I hope you guys are all doing well during these crazy times. I hope you all have an incredible day, and I'll see you all in my next video. Invest safe.